Welcome back to the deep dive. Today, we are getting into the fundamental architecture of, well, basically any business. We're talking about accounting transaction analysis and the balance sheet.
Yeah, and this isn't just theory for accountants. This is the numerical discipline that forces every single business decision into balance.
It really is. So, the sources we've looked at give us this fantastic roadmap. We start with the single most important equation in finance and go all the way up to these really advanced analytical methods.
Exactly. Our whole goal here is to give you a shortcut, really, a way to see the financial skeleton of any company you look at.
Because every time management makes a choice, whether it's, buying a factory or taking out a loan, the books have to reflect it. It has to balance.
That discipline, it all starts and ends with the accounting equation.
Yeah.
And it is absolutely non-negotiable. Assets, liabilities, plus equity.
It has to hold true after every single transaction, right?
Every single one. If your balance sheet doesn't balance, it's not a suggestion. It's just wrong.
Okay, so let's frame this for everyone listening. Assets are the economic resources. It's the stuff a company has.
Right.
But the genius of the equation is that it immediately forces you to answer, okay, but where did the money come from to get that stuff?
Precisely. The right side of the equation tells you the source of the funds. Liabilities, that's money from creditors, banks, suppliers, people the company owes money to.
And equity.
Equity is the owner's claim. It's what's left over. And it's usually split into two key parts,
You've got paid-in capital.
which is the cash owners put in directly for stock.
Mm.
And then you have the really interesting one, retained earnings.
Which is basically all the profit the company has ever made and decided to plow back into the business instead of, say, paying it out as dividends.
Yeah, so when you look at that right side of the equation, you are seeing the entire financing story of a company just laid bare.
And what keeps that equation perfectly level is this idea of the dual effect concept. Nothing in accounting happens in a vacuum.
It's the essential control. There are only three ways it can work. You can increase both sides, assets go up, liabilities go up.
Or decrease both sides.
Or, and this is a key one, you could have an increase and a decrease on the same side.
Just changing the mix of what's there.
Exactly.
So, to make this real, our sources use a startup called Veda Landscape Solutions. We don't have to go through every simple transaction, but they're great for showing the principle.
I agree. Let's take the first couple. The owner puts in $700,000 cash, and the company borrows $300,000 from a bank.
Okay, so $1 million in cash just came into the business.
Right. Assets, specifically cash, are up by $1 million. And the other side, it's up by the exact same amount.
Split between equity, the owner's $700,000 liabilities, the bank's $300,000. It balances.
Instantly.
That's the easy part. But the dual effect really shows its power in the more complex transactions, like when Veda bought that warehouse facility.
Ah, yes, transaction 3. This one's great. So Veda buys a complex for $450,000.
But it's not just one thing, right? It's land and a building.
Correct. $50,000 for the land, $400,000 for the building. But the key part is how they pay for it.
They use $100,000 of their own cash for a down payment.
Okay, so let's pause there. An asset, cash, goes down by $100,000.
But two other assets, land and buildings, go up by a total of $450,000.
So what's the net effect on the asset side?
It's an increase of $350,000.
Perfect. And to make the equation balance, the right side must also go up by $350,000. And that's the mortgage, a new liability, mortgage payable for $350,000.
It's amazing. It balances perfectly, even though, 5 different accounts just changed?
That's the control system.
Yep.
It forces you to track where every dollar went and where every dollar came from.
And then there was that last one, the asset exchange. Veda buys $650,000 of equipment with cash.
Right. So cash goes down, equipment goes up.
Both on the asset side.
Exactly. Total assets haven't changed at all. The company isn't richer or poorer in that moment. They've just changed the composition of their assets. Less liquid cash, more long-term equipment.
This all feels so precise, so logical. Which brings us to something that honestly is kind of shocking, what the balance sheet intentionally ignores, this idea of executory contracts.
This is usually the biggest aha moment for people. An executory contract is simply an exchange of promises about the future, a handshake deal that hasn't been fulfilled yet.
Wait a second. So if Veda signs, I don't know, a 10-year billion-dollar contract to buy supplies, that doesn't hit the books. Everyone knows that obligation is real. Doesn't that mislead people?
It does create a huge filter, but there's a logic to it. You see, Accounting principles demand that a liability can only come from a past transaction or event. A promise to do something in the future just doesn't qualify.
The obligation hasn't, what, crystallized yet?
That's the perfect word. It hasn't crystallized. For Veda, the examples were hiring employees. You don't record a liability when you hire someone.
Not until they actually work and you owe them a paycheck.
Exactly. Or signing a long-term truck lease. The contract is signed, but no entry is made. The obligation to pay only arises as you actually use the truck month by month.
So accounting is fundamentally designed to ignore future risks until they become present verifiable facts. It's backward-looking, in a way.
It prioritizes what has happened.
Yeah.
And so after all of Veda's startup transactions, their final balance sheet, it balances perfectly. $1,430,000 in assets.
And $1,430,000 in funding sources.
Mm.
And being a startup, it has that classic signature, 0 in retained earnings.
Right. All the equity is just the cash the owner put in. They haven't had time to actually make a profit and retain it.
But that pursuit of mathematical perfection, as you said, means it has to ignore uncertain things. Which gets us to the really critical business context here and the limitations of what these financial reports can tell you.
Yes. What important information does that perfectly balanced sheet actually leave out? This is where analysis begins.
Because it's often what you don't see that drives a company's real value.
Oh, absolutely. Think about a major regulatory investigation, say, by the SEC. That could result in massive future fines. It could tank the stock price, but you won't see a liability for it on the balance sheet.
Because it's an expectation of a future loss, not something that's already happened.
Exactly. Or, on the positive side, a tech company announces a revolutionary new product. The market goes wild. Everyone expects billions in sales next year.
But that expected future revenue doesn't inflate today's assets.
Not $1. Or even global economic shifts. A competitor nation suddenly increases its oil capacity, changing the long-term profitability for every oil company on the planet. Huge, value-relevant event. But it can't be measured or verified by a single company's accounting department, so it's not recorded.
It sounds like accounting is constantly walking this tightrope between being relevant, including what matters, and being reliable, only including what you can prove.
That is the perpetual trade-off. And we, as a system, have chosen to favor reliability. We stick to historical costs and completed transactions, even if it means sacrificing some relevance about the future.
So if you only look at the financial statements, you're only getting half the story. The objective, historical half.
Precisely.
Okay, so let's take that basic structure, assets, liabilities plus equity, and scale it up. Let's move from Veda's individual transactions to the strategic architecture of huge companies using these mixes.
This is where it gets really powerful. We can start with the asset mix. It's simply the percentage of total assets in each category. How much is in cash, how much in inventory, property, and so on.
And the number one thing that determines a company's asset mix is its industry, right? A bank is going to be full of loans receivable.
Of course. And a utility company is going to be dominated by property, plant, and equipment, all the power plants and transmission lines.
But the real insight comes when you compare companies within the same industry. The source material had a great comparison of retailers: Sears, Walmart, and Target.
A classic one. And you look at inventory. Sears had almost 40% of its assets tied up in inventory.
40%. Wow. Compared to Walmart, which was closer to 20.
Right. And that difference, that huge proportion, it's a massive red flag. It could signal really inefficient inventory management at Sears. Just capital locked up on shelves not being sold.
And then you see Target, with over 12% of its assets in receivables. That's a totally different strategic signal.
It tells you immediately that Target has a huge credit card business. They're extending credit directly to customers, which creates that asset. It's a riskier strategy, but potentially higher reward.
Now, this seems pretty straightforward, but there's a huge problem that can warp these comparisons. You call it the goodwill complication.
Yes, and this is critical to understand. Accounting rules only allow you to record purchased intangible assets, like the goodwill from an acquisition.
So when Sears bought Kmart, the value of Kmart's brand, name above and beyond its physical assets, that goodwill got put on Sears' balance sheet as an asset.
Exactly. But think about Walmart. Their brand is immensely valuable, maybe one of those valuable in the world. But because they built it themselves, it's homegrown.
It's completely invisible on their balance sheet.
Invisible. So when you compare their asset mixes, the acquisition-heavy companies look like they have all these intangible assets, while companies that built their value organically look like they have none. It really skews the picture.
So let's flip to the other side of the equation, the financing mix, where the money came from.
Right. And unlike the asset mix, which is mostly about industry, the financing mix is almost entirely about management's strategic choices. It reflects their attitude toward risk.
Let's go back to the retailers. Sears was, well, it was dangerously leveraged. Liabilities made up over 83% of its total financing.
An enormous number. They were relying almost entirely on debt, pension obligations, and other creditors. Compare that to Walmart and Target, who had a much more balanced approach with significant owner's equity.
And when you dig into that equity portion, you find the real story. For Walmart, almost all of its equity came from retained earnings.
That's the key. That tells you Walmart has this long, incredibly successful history of being highly profitable, and management has chosen year after year to reinvest that success back into the business. They fund their growth with their own winnings.
The contrast with Sears is just staggering. Their equity position was so strange, sometimes even negative, because of all the treasury stock buybacks.
Yes, we should probably explain that briefly. When a company buys back its own stock, it's recorded as treasury stock, which actually reduces total equity.
So Sears was aggressively buying back shares to prop up the stock price.
But in doing so, they were burning through their retained earnings. They were giving profits back to shareholders instead of reinvesting them or stabilizing the balance sheet. It's a strategic choice you can see plain as day in their financing mix.
So these mixes are a direct reflection of management's choices. The asset mix for operations, the financing mix for capital structure.
And those choices should, in theory, be guided by the corporate mission.
Right, tying the numbers back to the overall strategy. The mission statement is there to align everyone, shareholders, the board, management, and define what the company will do and, just as importantly, what it won't do.
And the specificity matters. You can have a really vague mission, like Microsoft's early one, to enable people to realize their full potential. I mean, what does that even rule out?
Not much. But then you contrast it with a company like Berkshire Hathaway. Their mission is turned into super specific acquisition rules.
Like requiring a minimum of $50 million in pre-tax earnings for any company they'd even consider buying? That gives management crystal clear numerical boundaries.
So we've really gone on a journey here. From the basic mathematical control of assets, liabilities, plus equity, through how transactions work, what accounting has to ignore.
With the executory contracts, yeah.
And then zooming all the way out to use asset and financing mixes as these really sharp tools to analyze and compare corporate strategy.
And for a final thought, think about this. The next time you read a financial headline about a company that's in trouble, go look up their financing mix. A heavy reliance on liabilities, on debt, especially when compared to their retained earnings. Well, that's a huge signal about management's attitude toward risk.
High debt makes you so much more vulnerable in a downturn.
So much more. Because you have to pay your creditors no matter what. A business that funds itself with its own profits, with its own retained earnings, is just structurally more resilient. The source of your funding is really the true source of your stability.
A powerful idea to end on. Thank you for joining us for this deep dive. We'll see you next time.